Welcome to the December MENA market briefing with the Refinitiv oil research team here in Dubai. Now, November and early December have been an exciting time for global oil markets, with crude benchmarks now recovering from their Omicron-induced rout. This gave consumers a moment of brief and welcome reprieve, but prices are again rallying and rising energy costs are still in the spotlight. With that in mind, we're changing tack slightly on this occasion and for this episode. Today, I'm glad to say that I'm joined by Refinitiv's lead coal analyst, Toby Hassel, and together we will offer some insight on fuel oil and coal market dynamics and the potential for fuel switching in the utilities space. So stay with us. So talk of fuel switching has been in the headlines a lot recently, and the price charts here show us exactly why that is. These charts compare LNG futures in Asia against delivered fuel oil prices for Japan. And the chart on the left shows that LNG prices have surged to all-time highs of around $35 per BTU. And that's nearly double the peaks that we saw last January. Now, the reasons for this are, broadly speaking, fundamental. And we're seeing a similar story play out in the gas market as we are in the oil market. In essence, this means resurgent gas demand is accelerating beyond the rate at which producers are capable or able to bring supply back to market. For an apples-on-apples comparison, the chart on the right, that compares the price on a barrel of oil equivalent basis. So in normal market conditions, or historically, LNG trades well below fuel oil. It has been a cheap source of energy, and as such, it's been popular among utilities providers. It's also quite a lot cleaner than oil in terms of carbon emissions, which is a particularly important consideration given carbon prices and where they are in Europe at the moment, and the implications that has for profit margins for power producers. Bearing all that in mind, fuel oil has become something of an antiquated fuel source for the global energy mix. However, with LNG now attracting around $850 per metric ton premium in Japan, and similar spreads evident in other fuel importing regions, the incentive to switch is now compelling, to say the least. So let's take a look at how the market is pricing energy contracts in the future. And we want to focus on the first 3 to 4 months of the curve, as this is the peak heating demand in the Northern Hemisphere winter. And starting with LNG, we see the forward market is in steep backwardation throughout. The chart on the left shows the JKMC has a calendar spread of around $5, $5.50 January through March, which is relatively steep and indicative of tight supply in the market. By comparison, on the right-hand side, we've got the 180 fuel oil markets in Singapore. They've dropped into shallow contango, with January deliveries trading actually at a $1 discount to March deliveries. So in complete contrast, this shows that the prompt market is actually somewhat oversupplied and weakening at the moment, despite the strength that we're seeing in the underlying crude futures. So there's 2 key takeaways from these charts. One, there's a clear price incentive to switch, as on a barrel of oil equivalent comparison shows. And also, it begs the question that, essentially, is the fuel oil market, given the prompt months and the prompt price spreads, is demand for power, fuel oil for power, as high as prices might otherwise suggest. To get a sense of the practicalities of fuel switching, we can turn reliably to the EIA. According to the agency, around 13% of operational power generators in the US are capable of switching from gas to oil. So that counts for about 138 gigawatts of total generating capacity. And what it means is that an electric generator is capable of switching completely from gas to oil as its fuel source. Now, in the US, that tends to be distillate fuel or residual fuel, and that's also similar in other parts of the world, in Europe and in Asia. Now, maintaining a degree of flexibility in fuel oil fuel supply has a couple of important strategic advantages. In terms of trade economics, it allows utility providers to preserve margins when fuel prices fluctuate, as they are today. There's also the matter of energy security, right? allowing suppliers to switch in the event of fuel shortages. This is particularly common in extreme weather events when gas demand spikes and suppliers tend to prioritize residential customers over industrial consumers. Now, it's beyond the remit of our task today to actually calculate in barrels per day the potential of oil demand created by fuel switching and then to extrapolate that globally. However, if you read media reports, we see consultants are quoted with estimates ranging from 300,000 barrels per day to potentially 500,000 barrels per day of incremental demand created by fuel switching. Now, what we can do, however, is take a look at ship tracking data from the Refinitiv database to see if fuel import patterns are changing. Now, there are anecdotal reports of fuel switching across Asia already. Here we have the Refinitiv ship tracking data, which shows fuel oil imports at major importing countries in North Asia. Now, the China data shows fuel oil imports are trending higher through the third and fourth quarters of 2021 compared to last year. However, we cannot necessarily attribute that to demand exclusively in the power sector. In fact, much of the import volume is for refinery feedstocks and possibly also bunker markets as well. Also, I think China has largely turned to coal to address its energy challenges and energy shortages, but Toby's going to explain a little bit more on that in a while. Turning to South Korea, this is another major importer, but again, straight run fuel oil is a popular refinery feedstock in the country, and this is particularly common when fuel crack spreads are weak, as they are today. We have seen, however, Korean utilities companies been quite active in the tender market. For example, East West Power issued 3 tenders to purchase around 100,000 metric tons of high viscosity, low sulfur fuel oil for delivery in October. That helped to contribute to the spike in monthly fuel imports, but year-on-year comparison shows no real dramatic change for Korea. Japan, meanwhile, that does actually have quite a high capacity of oil-powered thermal generators, which famously came back into fashion about a decade ago. Fuel oil imports are pretty low, however, and they show no meaningful change year-on-year as per the data. In fact, Japan has ample domestic refining capacity, which has a relatively high fuel oil yield. So the country is somewhat self-sufficient in that respect. Nevertheless, there are reports that Japanese utility firms, they have stepped up their domestic fuel oil purchases due to high spot prices in the LNG market. So turning quickly over to the Middle East and South Asia, we see here that price dynamics are very much the same as they are in Asia. These charts compare delivered LNG prices in West Coast India to fuel oil prices in the Arabian Gulf. Prices per barrel of oil equivalent show LNG spot cargoes are trading about 3 times higher than the price of fuel oil cargoes, and that's for January deliveries. So as we can see here again, this creates significant risk for regional energy, or significant risk for energy importers, and certainly incentive again to switch. So here we have the cargo data for major fuel oil importers in the Middle East and Southeast Asia. I think we should focus on Pakistan initially. The country has increased fuel imports considerably through the second half of this year. Our data shows that between July and November, imports have averaged around 418,000 metric tons per month. So that equates to about 88,000 barrels per day. Now that's an increase of around 134% from the same period last year. So that's basically more than double the volume. Power sector demand has been a major driving force behind those numbers. And utilities companies have been extremely active, issuing buy tenders for 180 CST fuel oil cargoes. That buying activity is actually set to continue in the early part of next year. Pakistan State Oil Company has issued purchase tenders for a combined 360,000 metric tons of fuel oil for delivery in January. Now, admittedly, those volumes are not guaranteed, and some November and December tenders did expire, in fact, and go unawarded. But this does indicate the urgency of fuel switching away from LNG spot cargoes for some players. Now, another one to look at is Bangladesh. It's another buyer of fuel oil for power, but the import activity is actually down year on year. Seasonal power demand in the country is falling, and there are reports that power producers have even skipped spot LNG purchases. So it may be the case that power producers are well covered at this point, but if not, that could potentially put more pressure on fuel oil stocks in the event of spiking power demand. We do have some data here for Saudi Arabia, which is another major fuel oil importer, but as far as we're aware, it does not appear to be driven by fuel switching. So that's sort of around more or less sums up what we're seeing on the fuel oil side of things. And I'm going to hand over now to Toby. He's going to give us some insights on what's going on in the coal market. So Toby, would you want to take it over from here?
Okay, great. Thanks very much, Tim. And it's great to be presenting with you today, and hopefully we can give some of our listeners and viewers some helpful insights on what's going on in the coal markets as well. So it's like many commodities, in 2021, coal markets have been very volatile. There's been the impact of a strong recovery in coal demand following the COVID impacts of 2020. There's also been some supply side issues, which I'll get into shortly. But I guess if we just take a look around some of the, a selection of the key benchmark coal prices around the world, looking at the API2, which is a European thermal coal benchmark. Top left, the front month, we can see, very, very sharp increase in the second half of this year, followed by a partial retreat in the past few months. Similar story, not quite as steep a spike in the front year thermal coal contract for API2, but still very significant when we compare, where prices have been this year compared with where they were last year. So, very significant movements in European coal prices. And a similar story in China. In the bottom left of this screen here, we can look at a couple of measures of prompt Chinese domestic thermal coal prices. You can see that, and I've actually got I guess an indicative band there that shows where China's authorities historically have preferred to see that benchmark domestic coal price in China. And you can see that prices, particularly through 2021, have been well beyond the top end of that preferred band. So energy and coal has been I guess a critical issue for China's authorities to deal with this year. And then I guess finally, just looking at what we've seen in the Pacific Basin for seaborne coal, the Newcastle high energy benchmark has seen a similar pattern in terms of pricing, with a very pronounced increase in prices in the second half of this year, before a partial retreat just in the past couple of months. So, Tim, if we could just move on to the next slide, I guess I'll take us through what's really been driving this volatility and in coal prices. And as Tim mentioned, fuel switching across the energy sector has been a very hot topic this year. And I guess what I'd like to call out with this slide here is the impact, just focusing on Europe at this point, but yeah, really focusing on the impact that very high gas prices have had on the economics of the power sector in Europe, and what that's done to coal demand. And so I guess our readers and viewers will, our listeners and viewers will probably be well aware of the fact that gas prices have been extremely high this year, and really, and particularly in Europe, where concerns about very low inventories have supported very high price. And I guess what's interesting from a coal perspective is what this has done to coal demand. And if we take a look at the bottom left, the lower chart on that slide here, what we can see is that the fact that gas prices have increased to such high levels has actually driven a pretty severe deterioration in the profitability of gas-fired power generation in Europe. So what that means is that gas producers have been incentivized to have faced a disincentive to produce gas-fired power. So and I guess the flip side of this is that we've seen a reversal of a long-term trend for coal in Europe. That long-term trend for Europe with regards to coal was that a greater volume of gas was coming into the power mix. Coal was moving out of the power mix, but that's switched in the past year, and coal-fired generation has become very profitable, and that's driven a sharp increase in coal consumption. And so that I guess that chart on the bottom of this slide, I guess, really demonstrates those dynamics that we've seen in the European power sector with regards to profitability in the gas and coal-fired generation space. So I might go on to the next slide, please, Tim. And this is a related concept, and what this chart shows is that gas prices, as I mentioned, have surged, and they've actually increased well above the fuel switching price, and this has driven substitution of gas with coal. So looking forward, we're actually based on forward curves for gas, coal, power. We expect that there's going to be a strong incentive, through coming months and even into next year, and pushing into 2023 for gas, for coal to be replacing gas in the European fuel mix. So that tells us that we should expect fairly strong demand for coal going forward, and I guess that leads us into the next slide, which is the supply side issues that the coal market has faced. So I guess against that backdrop for coal demand, the recovery from the COVID impacts of 2020, economic activity has improved, so coal demand has lifted, plus those coal and gas fuel switching dynamics that I've just talked about. So against that backdrop of strong demand, coal supply has been severely constrained. And we've seen across the key seaborne coal producing countries, Australia, South Africa, Colombia, Indonesia. If you look at those charts and compare export volumes for 2019, which I guess we'll call that pre-COVID, compare 2019 export volumes with the 2021 year-to-date annualized export forecasts or export figures for this year, and that's based on year-to-date run rates. You can see that we are well below those pre-COVID levels. So economic activity around the globe has largely recovered from those COVID impacts of 2020. But looking at coal supply, we're a long way below where we were in terms of export volumes in 2019. So that gives you, I guess, a bit of a picture of what's driven these sharp increases in the coal price. In fact, when we look at those five major coal export nations, it's been only the Russian Federation which has been able to lift export volumes in 2021 relative to that 2019 pre-COVID level. And you might have had a bit of a look through that right-hand side text that discusses some of the issues that have plagued the coal supply coal suppliers in 2021. The list, I mean, that's not an exhaustive list, but it gives you an indication of just what the sector has faced in terms of disruptions and constraints that has limited the supply of export coal into global markets. So we might move on to the next slide, Tim, please. And this is the final slide for me today. Another issue that coal markets have been dealing with through 2021 has been related to geopolitics and more specifically trade restrictions, most notably between China and Australia. And this has been in the news quite a lot. And it's had a fairly significant impact on seaborne coal markets. So that top right chart there shows you that exports of coal from Australia to China have slowed to a trickle. Very little coal now flowing from Australia to China, and this follows reports of an import ban imposed by China on imports from Australia. So this has really led to a redistribution of global seaborne coal flows because China needed to I guess replace that lost volume from Australia with coal from other origins, including Indonesia. And you can see there in the top right chart that a greater volume of Indonesian coal has been flowing into China. And then I guess looking at those left-hand charts, you can see there that through 2021, Australia has been shipping an increased volume of coal to Japan. Meanwhile, Indonesian coal exports to Japan have basically halved compared to the previous year. So Indonesia is shipping more coal to China, less coal to Japan. And then finally, bottom left-hand chart shows coal flows to India from Indonesia and Australia. We can see that Australia is now shipping much more coal to India. Conversely, Indonesia is shipping less. So, as I mentioned before, more Indonesian coal flowing into China. So, yeah, this has really led to a redistribution of global seaborne coal flows, and it's certainly had some. There have been some price impacts as well when we look at the relative prices for coals from different origins flowing into different destinations. But I guess, yeah, the coal market and the coal trade has adapted to these restrictions, and moving forward, there's not much. There's not many indicators that suggest that these trade restrictions between China and Australia will be lifted in the near term. So I think we can expect that this reallocation of trade flows will persist going forward. And that was all that I was going to speak about today. So I might hand back to Tim to wrap up. Thanks, Tim.
Yeah, thanks, Toby. That's actually really interesting, because it's a rare chance for us, oil folks, I suppose, to really pay attention to the fundamentals that are ongoing in other energy markets, not only coal but gas as well. Because we often look at it and we discuss it every month on this podcast, but often in isolation. So it's listening to what you said there, Toby, I think it's generally pretty bullish for prices across the board, I suppose. And that's kind of where we are today, I think, or indicative of where markets are today. We've got oil rallying rather, after a recent scare. LNG looks like it's back at the highs. Coal prices, like you say, they've come off, but it looks like there's still ample incentive to continue buying, given the forward curve as you demonstrated there. So I suppose, what is concerning is that with that strength across the board, and we're heading now into the Northern Hemisphere winter with peak heating demand just around the corner, you kind of ask yourself, what is the potential for prices to go higher from here? Something we didn't discuss, I'll have the opportunity to discuss on this episode, is the outlook for weather, but I think that's going to be particularly important over the next few months. I saw you did touch upon it on your slide there, Toby. But broadly speaking, I think the climate forecasts seem to indicate that there's a mild weather up ahead for Asia and for Europe. In Europe, temperatures for December seem to be trending above long-term averages for this time of year. In Japan as well, the meteorological agency foresees a low probability of a La Nina climate event, which therefore indicates a mild winter in Japan. But that can change in an instant, and if there is a cold snap, that could create a meaningful spike in demand. And with inventories already low and prices high, a sudden rush in spot purchases creates a scenario that is potentially very bullish for prices across the board. So I'm going to say thanks very much again for Toby for joining us, and we'll catch you again next time.